Are you looking for some great Canadian stocks to add to your portfolio right now? Are you looking for stocks that are undervalued at the current moment? If so, stick around, because that's exactly what we're covering in today's video. What is going on, you guys, and welcome back to the channel. If it's your first time here, my name is Brandon. As always, we do have our Investing Academy. It's that first link down below in the description if you're looking for courses and training. But today we're going to be going over 3 great long-term companies, all Canadian, and all at the moment trading at a discount. We're actually going to be going over some Morningstar price targets, which we don't usually do for a couple reasons. I don't typically like it when investors live and die by these price targets, because the reality is, for one, they're often wrong. They're often changing, and these big analyst firms are constantly adjusting their price targets just to make everybody happy. Half the time they're flat out wrong. Second reason being that even if they are correct, even if their analysis is correct, they've projected out properly and they've got a fair value on a company, sometimes it takes, and I'm not exaggerating when I say this, sometimes it takes years and years for a market to get a stock, to properly price a stock. Stocks can trade either below or above their fair value, or what we at least believe that should be, for years and years. So looking at a price target doesn't always give you, it's not the be all end all. It can just be a big mistake if investors are living and dying by the price targets. That said, as we'll look at today, all 3 of these companies do, at least by Morningstar's standards, at least by their values, look undervalued. If you enjoyed this video, all I ask is to give it a quick thumbs up. But let's dive on into the first stock, which is the company Restaurant Brands. I don't think I've ever done that before. Today we're looking at a dividend of 3.91%, and the stock trades for $70 Canadian. Now, based on Morningstar's projection and what they believe the fair value of this company should be at, they've got it set at $88, which represents about a 20% discount as to where the stock is currently trading. This is, of course, the company that was formed in 2014 when Burger King merged with Tim Hortons. We have covered them a couple times on the channel, and actually quite recently, over the past number of years, they've actually added the brand Popeyes to their umbrella. That's one of the companies under the Restaurant Brands International's name. I'm personally still yet to try the chicken sandwich, which apparently is very, very good. Probably because we don't have too many Popeyes locations here, at least in my area. In my area, we go to LA Chicken, but that's a whole nother story. To me, the area of fast food or quick service restaurants, that's actually where they get the ticker, QSR, if you didn't piece that together. This is an area that, if you look into it, is just an absolute bellwether in the sense that there's always demand for it. The fast food industry in 2020, this is in the US alone, does over $250 billion a year in revenue. If you take a look globally, over $630 billion of revenue and growing. That's projecting out going forward. This is just a massive space to be in. And for a company like Restaurant Brands, they've obviously got their locations domestically, but as well as internationally to capture some of that outside growth. If we take a look at some key statistics, looking at Restaurant Brands relative to its closest competitors, in this case, McDonald's, and then the company Yum Brands, which makes KFC, Taco Bell, etc., you'll note that under the assessment tab, this company is showing the deepest value of the bunch, trading at a 20% discount relative to a 4% and then a 5% discount. But what's most important about this is up in the currency tab, we see that this is a Canadian listed company. And it's so rare that you find a company in the fast food area. It's rare that you find a company in the quick service industry that's not based or domiciled or domesticated out of the US. That to me is where QSR can fit a very unique niche in a portfolio. For example, as a great option is to kind of complement maybe a major US fast food company. Like myself, for example, you guys know how big of a fan I am of McDonald's. It was one of the first stocks I ever purchased, and I don't see a reason why I would never want to own that company. Well, that could give me my US exposure, and a company like QSR could be a nice component to marry that up with. If you're the type of investor that doesn't want to invest in the US, which I know there's a lot of you guys out there for currency conversion reasons, whatever the case is, QSR could be a great option to give you exposure into this fast food space. To me, this area is just super reliable, and it's an area that everybody should have at least some exposure to in their portfolio. The stock pays a great dividend of 3.91%, and as we can see dating back to 2019, shares are still down over 30%. It would have been great to scoop some up during the COVID sell-off, but even now, with the Morningstar fair value at $88, I think QSR is a great stock to look into. Trades for $70 Canadian. Stock number 2 on this list is gotta be one of my all-time favorites. It's the company Bell Canada, ticker BCE, and today we're looking at a dividend of 6.29%. And yeah, I read that right, 6.29%. Morningstar values the company at $65 per share, which represents 19% upside from where it's currently trading today. Bell Canada, as everybody knows, is one of 3 major providers here in Canada. I actually was reading through Reddit just a couple days ago and came across this post saying that TELUS, Bell, and Rogers have the highest wireless prices in the world, which is of course sucky for you and I, the consumer. We're paying all these high prices, but as a company, as an investor, as a business owner, if they can get away with charging those prices, we say, hey, we'll kind of take that. It's been clearly reflected in the share price as Bell has done quite well over the years. One thing I do say to keep in mind is when we talk about Bell, we think to the cell service, but they are quite diversified from TV, internet, even media. Take the subsidiary Bell Media, which really helps diversify their income. And to me, it's quite a healthy balance in the sense that they're not relying and they're not overexposed on one area. If, for example, regulations come in and they have to cut their rates, it's good to have that spread out or diversified income stream. If you do follow along with the company closely, you'll know that they just reported earnings a few days ago, and without a doubt, it was a tough quarter. You take a look at some of these numbers, brackets obviously represent declines year over year. What I do think is promising about this, however, is that it's more or less macro driven events. This is more or less the top level stuff that's really impacting the company rather than Bell Canada doing an extremely poor job. The reality is, to me at least, Bell Canada is a company that's not going anywhere anytime soon. And the weak quarter, which is then reflected in the share price, if we actually look, I mean, over the past year, Bell has actually kind of creeped down about 16%. That to me is something we like to see as a chance to go in and buy at a better price. They did declare their dividend, just FYI for anyone interested. Again, that yield at 6.29 is the current yield. Payout ratio is a little bit high, is quite high at the moment, and that is something to factor in. But this is not a stock that I would be investing in solely for dividends. This is one that you take on for the growth, and the dividends is a nice, healthy bonus. Bell and TELUS and Rogers pretty much have a total command over the Canadian market. We don't really go to any other providers. I mean, if we do go to other providers, they're very likely owned by these big behemoths. And of course, with the 5G rollout, that's only going to benefit them going forward. The stock today trades for $52. And again, the Morningstar price target that we're looking at is 65, representing the upside potential of 19%. On to our third and final stock, another stock with a crazy dividend at the moment. It's the company Enbridge. Today, we're looking at an 8.47% yield. Crazy to think about. Enbridge today trades at $35, and Morningstar has them ranked with a price target of $56. This represents a 36% upside to where it is trading today. Enbridge is, of course, the energy company. They're responsible for distribution. They're responsible for the transportation of energy pretty much all over Canada and the US. They'll have pipelines involved with crude. They'll have pipelines involved with natural gases. I actually was curious to ask because I know this whole energy area, it's very polarizing. I know even amongst our viewers, you have some that are for it, some that are against it. Leave a comment down below just to let me know what your thoughts are on energy. Is this a dying out space? Is it a good investment opportunity in your opinion? Let me know down below. Obviously, when it comes to Enbridge, one of the key reasons you'd invest in this stock is for that dividend. The dividend metrics, in my opinion, are some of the nicest ones we can find. These numbers, whether we're looking at growth over the past 3 years, over the past 5 years, been growing for 7 years, the consistency and the track record, as you can see below, dating back to 1995, they've just been paying out great dividends year in and year out. This is something that the company really, really prioritizes. They actually just declared, again, this is just a few days ago on November 3rd, that yield is still correct. They're still paying out the quarterly dividend. For a quick little teaching point, or at least showing you guys how I view dividends and how I view a stock like Enbridge, if you took a look at this dividend history, which basically to me showcases they've for the past 20 years, paid out a dividend in the range of $2 to $3. Obviously, it varies, but let's call it a $2 average. Then you marry that up with the share price, where the stock has slowly and steadily came down. What that tells me is that we can now pay less and less per share to get that same $2 dividend. Again, I'm just averaging there, but that to me is really the way I look at it. If you look, for example, at a high point in 2015, you were paying above $60 per share to get a $2 dividend. Now we look where the stock is trading today. Well, we're paying $35 for that same $2 dividend. That's again how the yield corresponds with the share price. Again, that's more or less just a point, not really related to Enbridge, but of course, this is a stock that is now piquing my interest. One thing that may have slipped by you in the news was actually quite recently. We saw Warren Buffett go out and close a deal, or they're closing the deal with Dominion Energy. I believe this was an $8 billion deal. This is obviously a company over in the States, so not an apples to apples comparison with Enbridge, but the king of value investing, the king of finding deals out on the market, is dipping his toes in the energy market. So what does that say? And it's funny to me, I know everyone just copies Buffett. That's not why I included it in the video. I know people learned that the hard way with the airline stocks on YouTube. I know my friends, for example, that just bought when he bought, and when he sold, when he said, hey, maybe this is not the industry to be in, he sold, everyone just followed suit. That's not why I include it in a video like today, but to me, that is a little bit telling. This is just my opinion, and you don't have to agree, but I don't think the energy sector is going anywhere. And if you're able to look at it with a long-term perspective, we may be getting some very nice prices on some stocks pretty much across the board. Actually, Enbridge is down about 44% over the past 5 years. So it's been a slow, steady decline, which has been very painful for investors. But hey, if you do believe in this recovery play, if you like to see promising signs from Warren Buffett, for example, Enbridge could be a great stock to look at. Today it trades for $35.82. Again, with Morningstar's target of 56, representing an upside of 36%, not including dividends. So guys, that is my video on 3 undervalued Canadian stocks to buy right now. I know there are so many other exciting stocks on the market, and I get questions about them every single day. Why don't you cover this? Why don't you cover that stock? And one of the most reliable strategies, in my opinion, is to just look at these good quality companies, buy them when they're on discount, and over the years, they'll fluctuate, they'll go up and down, and if we can pick them up at low prices, I think we can do very, very well. If you guys enjoyed today's video, give this one a thumbs up. Let me know your thoughts down in the comment section below. If you're not already subscribed to the channel for whatever reason, hit that subscribe button, because we post videos every single week, usually 1 or usually 2, sometimes even 3. And of course, we do always have our Investing Academy. It's that first link down below if you want courses and training on pretty much the whole 9 yards when it comes to investing. From start to finish, we have a community where you can ask questions, meet the other students all across Canada. It's really quite cool. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.